love the channel and find it useful in becoming a happy retiree. Subscribe today. I want to talk about, I think, a bigger, more fundamental issue that plagues investors, and that's when we watch financial television or we listen to financial radio, present company excluded. I'm talking about full-time financial networks like Bloomberg and CNBC, and their whole job is to cover markets, economy, currencies, Bitcoin, every single day, minute by minute, 24/7. And who they have on those shows are the very, very top money managers and investment guys on the planet, men and women on the planet. And I came across and I don't think this was set up at all. This happened to be a kind of a heavyweight fight this week on CNBC without it being set up to be a fight. I almost think they did it I think it was a big accident, but you had two financial heavyweights in what I think is a really important conversation and major disagreement that leads to which is a perfect example of the confusion that besets so many investors. So this, and I'm going to play this clip here in a second. This is a fascinating discussion between Thomas Lee, he's from Fund Strat Global Advisors, and Mike Wilson from Morgan Stanley. All right, both of these guys, financial heavyweights. Mike Wilson, and I'm going to play this clip in just a second. It's about a two-minute clip. Mike Wilson is the chief equity strategist and the CIO, chief investment officer for Morgan Stanley Wealth Management. Big time, right? Thomas Lee, he's the head of research for Fund Strat Global Advisors. He had basically the exact same job as Mike Wilson did, but he had it at JP Morgan, another financial super heavyweight. He was JP Morgan's chief equity strategist from 2007 to 2014. And that's how I learned about Thomas Lee. Made a lot of really good calls going into the Great Recession, was very insightful about what was about to happen, and then was really good about calling the market as it started to come back from the depths in March of 2000. He's been a top rank analyst. He's been, one of the top, 20, 40, 50 guys on Institutional Investor, their list every year since 1998. So both very smart, both accomplished investors and strategists. One of them, and this is why I want you to listen for, one of them says, hey, we're at the end of this business cycle. We're at the end of our rope, effectively. Markets are near their top. The other one says, no, we're in the fourth or fifth inning. And we have 11 years of expansion to go. By the way, as far as markets are concerned, Lee says he sees markets. Well, I'm going to let you listen to this clip. So I'm going to play this, and this thematic. I want to discuss and understand this theme throughout the show today, and I will take your calls and questions. So Ryan Ely here. Give us a call in the studio. We're happy to discuss this, happy to answer your questions. The number here in the studio, 404-872-0750. Again, 404-872-0750. Let's go ahead and play this clip.
It's important for investors to think long-term. And I think if you think long-term, the things that really end up being risks for stocks is misallocation of capital. Like, is the economy over-allocating to low-return projects? And I think what we've seen is, look, we've had so much caution since '09 that animal spirits have been depressed. Now we're starting to see the surveys, small businesses, ISMs improve, and there's a lot of pent-up demand. So I think it is tough to say where we are in the cycle. I think it's closer to mid-cycle, like if you look at housing starts, even auto sales and investment to GDP ratios, and then you look at global sort of business cycle, it seems mid-cycle. So I think it's important to think long-term, and long-term, you're suggesting that we're saying the fourth or fifth inning of a bull market? Yes. I mean, I think it's interesting. So, we do a lot of long-term work, both myself and Rob Slimer, but I think both of us think it's more like 2029 is the peak of this equity market cycle. And then, the S&P is 6,000 to 15,000. So, I think it's just important to be long-term oriented.
We're going to do the math on that number you just said.
Well, look, I mean, I agree with that from a secular.
This is Mike
bull
Wilson
case.
just chiming
but
in.
From a cyclical bull case, I don't agree with that at all. And I think it's pretty clear to us that we're late cycle from an economic standpoint. So the two things I would point to is the unemployment rate. I mean, we're 4.1%. We're 50
Could have a 3 handle on it, according to some, soon.
Right. So what does that mean? There's not a lot of labor left.
What does that
mean? And that's
mean?
really the key ingredient for calling an economic slowdown. When you run out of labor, costs go up, and then basically that's when companies fire people. And that's what causes an economic slowdown. That doesn't mean the secular bull market is over. But to kind of make the suggestion that we have 2 or 3 more years left in this cyclical sort of expansion, I think it's very misplaced.
Wow. Let's do some math here. So one of these guys, so Thomas Lee says, hey, we're in the fourth, or basically in the middle of the cycle, 4th or 5th inning, meaning the economy has a lot of runway left to go to the upside, which means we have a lot of stock market upside to go along with it. 11 years of expansion to go. The world's going to be a different place in 11 years. That's a long time. By the way, let's do the math on this. As far as markets are concerned, he sees the S&P 500 at between 6,000, and this is on the S&P, not the Dow now. Remember, the S&P 500 today, it's about 2,800. So we're let's say almost 200 points shy of a round number 3,000 to give you some context. If we do some, he says we'll be in 11 years, we'll be at 6,000, or we'll be at 15,000, somewhere in that range. Well, let's do the math. 2,800 today to 6,000 in 11 years. When you start to throw out these long-term numbers, they seem almost a little crazy out of the gate until you do the math. In 11 years, that's not an egregious number. If you look at the annual percentage rate of return to go from 2,800 to 6,000 over an 11-year period of time, it's a 7.17% rate of return if it happens over 11 years. To reach 15,000, now that starts to get a lot frothier, if you will. But to reach 15,000, you'd have to average 16.5%. Again, we've actually done we've done about that since the recovery. I doubt we're going to continue at that pace. But that's the range that Thomas Lee is talking about, 7% to 16%. Now, again, this is not some off-the-wall strategist here. He co-founded FundStrat in 2017. He was the top stock strategist at J.P. Morgan. He was one of the very few Wall Street analysts to predict Trump winning the election, first of all. And not only did he go on record to say that he would win, he also talked about a rally in stocks, the Trump rally, where most analysts were saying, hey, markets are going to crater if Trump were to get elected. So Thomas Lee has a lot of credibility, been around for over 25 years, and he's been very right lately. So we don't want to dismiss a guy here that has a lot of credibility, a lot of Wall Street credibility. But Mike Wilson, on the other end, he's a very bright guy too, but they disagree significantly, and that's the confusion. And this is a perfect example of why it's so confusing to invest. Who do you listen to? These guys are saying totally different things. They both know what they're talking about. And by the way, they both have really important points. And that's what I want to try to decode today for you here on Money Matters. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.